Good morning and welcome to Provaris Energy's presentation at the NWR Vantage Point Conference. From the company today, we have Managing Director and CEO Martin Carolyn. Before I hand it over to Martin to go through the presentation up on the screen, I'll just remind you we're trying to keep this reasonably punchy in terms of 10 to 12 minute presentation, followed by more of an interactive Q&A. So if you did want to ask a question, Q&A panel's at the bottom of the screen, and we'll get to those post the end of Martin's presentation. Martin, I'll hand it over to you to get started. Thanks very much.
Thanks, Simon, and good morning, everyone. Thank you for taking time out of your day to hear about Provaris Energy. We are a developer of integrated supply chains for hydrogen. So we're doing development of molecules, we're doing storage and transport, and the downstream distribution. Today's presentation, I'll try and avoid too many technical concepts and stick to the key themes, and we're keen to take questions. So our strategy is to deliver hydrogen in a regional context, and we've been focusing both in Asia and more recently up in Europe. And the European requirement for hydrogen is now determined that it's 10 million tonnes of import by 2030. So what does that mean? That really means that decisions on investment on projects and investment decisions need to get going in the next year or two. So if we look back at the key thematics across the sector. So you've seen 25 countries in the last 2 years talk about roadmaps for supporting net zero targets, and hydrogen is one pillar of those roadmaps. We've seen many projects announced in terms of investment for supply chains. We've seen immense amount of policy support continue over the last 12 and 6 months, in particular from Europe, the US, and more recently Australia. You continue to see policy support. And the capital markets, you don't often see too many projects going to FID, but I can say that there's a significant amount of capital sitting on the sidelines looking for bankable projects to invest in. So the key themes that we put through in our supply chain, and what's the differentiator for Provaris, is energy efficiency. It's one of the key pillars of the European Energy Directive and investment process. So going back to the Green Industrial Deal in the last couple of years, efficiency is key. So we provide flexibility to be able to what we call load follow the generation profile of renewable sources. What that does, it drives down a lower delivered cost of hydrogen. And we put out a recent study to support that. As a company, we're advancing projects on a regional basis. So we're looking at production, transport, and distribution, both in Asia with our TVH2 project and supporting other projects up into the key markets of Singapore and then further afield in Korea and Japan. And then in Europe, we've opened an office in Oslo. We've announced a joint venture to develop supply chain projects, and we've been working with other third parties there on collaborations for supply chains. What we bring to the table, we're not just developing projects and concepts, we actually have unique IP, and that IP around the storage of bulk hydrogen in a compressed form is working for both shipping and more recently in storage. So it provides the industry first mover advantage. What is known, and this is not our statement, that storage and transport is crucial to the establishment of supply chains, and that's a fact. If you look at the macro picture in terms of supply demand, the current market in 2020 for hydrogen was predominantly grey, less than 2% produced through electrolysis, or what would be green hydrogen. So the next 10 years through to 2030, we're looking at that market doubling. That's going to come from various sectors. The sectors that we see, so 100 million tonnes, where's that coming from? We've been spending more time in Europe and in parts of Asia the last 4 months and the last 6 months. So steel producers looking to produce green steel. So that's a change to their DRR process, removing coal. So chemical industries, large emitters of carbon, and then refinery products that all the majors are running in different distribution channels. Power generation. When we talk about power generation, there's co-firing of combined gas cycles, so that's blending with natural gas. And indeed, when you look at markets like Singapore, new power-intensive industries are required to have renewable power. So that would be a combination of grid and hydrogen. And then the heavy-duty vehicle market, which is really emerging, in particular in Europe. If you've travelled in the autobahns of Germany, there's basically one lane of heavy trucks, which are large emitters. Policy, as we mentioned, is key. So we've seen the Green Deal Industrial Plan, the IRA Act, which encompasses lots of things, but that comes with both policy support, but ideally in funding and capital and incentives. We talk about the Repower EU initiative, which is driven by decarbonisation, but also today, energy security is a key focus. So with the war in Ukraine, that changed the whole energy dynamic. And so energy security has advanced the need for the hydrogen market. And then in the next few weeks, we should see some key policy go through the European Union around what's called the delegated acts. That's we see as key catalysts for binding offtake on project and FIDs to take place. So Provaris, we talk about developing integrated project. What is that? This is quite a busy slide. We're not going to go into all the technicals, but we do production, storage, and transport, and we do that through our unique IP around the storage systems. So it's about developing innovative solutions which are safe, simple, efficient, and that drives key economic outcomes. So the supply chain is put together there in the middle of the screen. So you've got production on the left-hand side, and in the blue box is really what's our core IP. So that's how we compress, store, load, and transport, and then unload into regional markets. So that's the floating pipeline concept. To do all this, where we're going to make money, we will make it in long-term offtake for the hydrogen molecule, which is delivered through that supply chain. We could also do midstream services only with third parties, which is long-term contracts for shipping, fleet, and storage. We may only do storage devices, or we may, in the long term, develop projects and have license fees for our technology and development programs. So that all brings together attractive cash flows. And I think the key to all this is unlocking binding offtake, which then will fund all of these assets to be produced and developed. In terms of our IP, we've got our H2Neo ship, which has gone through a large amount of design, risk studies, and feed level design packages. So we've received approval in principle for this design concept back in 2021. Late last year, we received what's called feed approval. So that is a very detailed design package, which we're now working with yards around quotation for capital and constructability. And then we have the H2 Max, which is the second generation, which is a larger carrier. So 2027 is the target for our first shipping fleet to be operating, either in our projects or in third-party projects. And then the larger scale vessel is beyond 2030. What's also interesting is we've been approached to look at can we do a floating storage solution using the H2Neo design. So we've announced that in the last 2 months, and so that's called the H2 Lure. So that is a capacity of 300 to 600 tons, which we see as integral to the development of all supply chains, not just our own compressed H2. So we talk a lot about the factors that make up the costs of supply chain and why compression works. So compression's been around for 50 years. It's a proven application for the storage of hydrogen, but what hasn't been done is in a marine context. So a marine solution provides flexibility for both loading and unloading. Our supply chain looks to be the most efficient and scalable in the early years. We can load, follow variable profiles, and then what's that doing? It's actually eliminating other factors such as batteries and storage, which is required for all of the supply chains. So that translates to a lower delivered cost and a more efficient process. And again, I'll refer to a recent comparison report we put out in the last couple of weeks, which talks about a number of those factors. But the key point is energy loss. So where you're trying to deliver renewable electrons as molecules at a certain point, it's all about efficiency. So the results, we often get asked, what is the delivered cost of hydrogen and how much to produce and transport? So here we've released results looking at different generation profiles at different scale of volume and different market transport distances. So you can see here that a delivered cost model, which includes the full production cost of curtailment, losses, shipping conversion back to a gaseous hydrogen, that our H2Neo, which is the dotted line, and the green line, which is the H2 Max, is the lowest cost we see, and it makes it compelling for distances up to 2,000 for the H2Neo, and then beyond longer distances in the future, the Max is still very, very competitive. So where are we doing that? In Australia, we have our TVH2 project, which we announced in 2022. We've been advancing that through scoping and pre-feasibility. That contemplates the export of 100,000 tonnes from the Northern Territory up to ideally Singapore. And then in Europe, if you look at the 2,000 to 3,000 nautical mile radius of which we are competitive, you've got a number of supply points, and we've been looking at development projects in the green locations, so North Africa, Southern Europe and Northern Europe into the key ports of Germany and the Netherlands. We have announced an office in Oslo, and we are progressing with technical partners there. The TVH2 project itself, it contemplates 2.8 gigawatts of solar generation only. That would produce 100,000 tonnes of exported green hydrogen through electrolysis. Our program is targeting first exports late 2027, and we are in the process now of developing our environmental impact study and doing pre-FEED activities. From a Northern Territory perspective and the benefits for the Tiwi Island people, we've got major project status. There will be a number of construction jobs, but importantly, economic benefits being operational jobs and revenue and income for the Tiwi Island communities will be key. If you look at the map on the right-hand side, clearly this is the furthest most export point coming from Australia into the key markets of Singapore at 1,800 nautical miles, and there's benefits to Korea and Japan. So we see the deep water port there, the traditional ownership, good solar intensity. We see this as one of the first export projects which could be put through in 2027 for Australia. So the recent initiatives around Hydrogen Head Start and other supporting activities, we are working with those organisations to advance our project to a point where they qualify for that funding, and we think that has a good outcome later this year. With respect to Norway, we opened an office last year. We've been working with agencies and different third parties looking at export projects. Provaris has been identified as the missing link. So the distance varies between 300 nautical miles and 1,000 nautical miles from Norway down to the major ports of the Netherlands and Germany. So very attractive from a distance perspective. We've announced our first partnership with Norwegian Hydrogen in January this year. We've already completed a pre-feasibility study which contemplates up to 50,000 tonnes of export capacity. We've announced the initial transport cost range of $1 to €150. That's excluding production costs. So we see that as highly attractive from a transport cost perspective, and we're now advancing that, and we'll make further announcements about that project shortly. There are other opportunities, so we see Norway as a multi-project country for us, and you've got a very supportive Norwegian government. You've already got the country 95% electrified, and they have ambitions to be involved in delivering energy to Europe. So the production costs can be very competitive using grid-connected hydro, and there's significant offshore wind and onshore wind proposed going forward. So we've been lucky to get the support of Innovation Norway and the Norwegian energy partners to help advance our actions there. With respect to how does hydrogen get scaled up and delivered into Europe? So what's not well understood here is that there's concepts such as the hydrogen backbone, the hyperlink. So these are dedicated hydrogen pipelines which are now being sanctioned for development, going through 24, 5, and 6. They connect to the major ports of Europe. So it's about developing an open access large-scale hydrogen network. And what the intention is to get beyond the port districts in the regional areas and down into the industrial heartland of Europe, which is predominantly southern and west Germany. We've been travelling through the Lower Saxony last month, and we've got people again here in the region this month. So we are talking now to steel mills, chemical factories, and key users that are looking for diversity away from existing fossil fuel sources and supplementing that with hydrogen. So there's a key market appearing. So ports, pipelines, and the customer base is certainly starting to appear, and they're all looking for simple, efficient solutions, which we're now demonstrating through our approach with compression, but also advancing projects. So if we can announce the formalization of volumes in the region, we think there's a strong conversion to customer offtake this year. So what are the key takeaways? We continue to see storage and transport as a key requirement. As recently as last week, we witnessed one of the senior BP executives make the statement that those companies that can crack the code on shipping efficiently and cost effectively will be positioned for the international market. We are in that pocket, and our evidence suggests that we can be the most efficient over certain volumes and distances. So hydrogen is it's a key pillar for net zero targets. It's not going away. We continue to see increased policy and funding. Our economics around compression are compelling, and that's now starting to be viewed more seriously in the market. We have multi-project potential in Europe, and we're still looking at Asia and Australia. And this opportunity extends into storage solutions, which is an extension of our IP, and we'll talk more about that in the coming months. So we see the value creation is significant for shareholders today and moving forward. Thank you, Simon. Happy to take questions.
Perfect. Thanks very much, Marty. First question, what cost per kilo do you estimate the TVH2 project could produce at?
Well, we haven't released that to the market at this point, Simon. We have developed a pre-feasibility model which suggests that it can be competitive on a global scale. If you look at the numbers that we produced in that chart and in our release around solar or to hydrogen delivered, it's within that delivered range of around $6 to $7.
Great, thanks, Martin. Europe's already well connected with hundreds of gas pipelines and the seafloor is well mapped. Intuitively, if I were a large oil and gas operator that has diversified into hydrogen, why should I ship my compressed hydrogen regionally instead of utilising the pipelines?
Yeah, that's a really sensible and fair question, and one we get asked a lot. You're seeing a lot of news around the development of proposed pipeline grid networks, and we spoke about that before. If you look at the natural gas market today, there's some 600 LNG vessels on the water, and there's still another 200 new builds on order. So the role that shipping plays is not going to be removed just because you're transitioning to hydrogen. Those key demand regions, such as Europe, they simply can't produce enough terawatt hours in renewable energy or convert that to hydrogen molecule, which is required for decarbonisation. So those markets will still need import solutions. And the fact that you see ports proposing import terminals is evidence that the shipping market will continue. How you map the seabed is not my expertise, but the environmental and time required to develop new pipelines subsea is extensive. And then you get the geopolitical risks such as Nord Stream, which has recently had some issues. So I think pipelines play a key role, but shipping doesn't go away.
Great, thanks. And can you just talk to why the delay in adoption of green hydrogen globally? And can you discuss the level of interest that Provaris has witnessed in the past 6 months?
Well, the adoption needs two things. It needs supply and it needs an end market, right? And I think the regulatory process to connect those two, and so that's all moving more quicker than it has in the past. So I think what we need to see is projects get sanctioned. They'll have long lead items, they're capital intensive, and then we'll need to see the downstream applications. So you are now seeing ports and pipelines fill in the gap. So I think the regulatory actions that are taking place in Europe this summer around the Deregulated Acts provide certainty around what is renewable green hydrogen and what's the cost of carbon. So there's a number of factors, and I think those changes are taking place. Our time in Europe has seen an urgency to get things done. There's been a lot of proposed solutions in the last 2 years around large-scale liquefaction and ammonia, but we haven't seen liquefaction projects move forward. Ammonia is not hydrogen. It still needs to be cracked if that's the use case. And so the simplicity of our solution is starting to resonate.
What's the competitive landscape like for storing and shipping hydrogen, i.e. main players or competitors, either the only one using compression at this stage?
So we are the only ones doing bulk scale, bulk carrier shipping in a compressed form. So our design, which has been well documented, the only alternative is to do shipping containers full of high pressure ISO tanks. Those tanks and shipping containers are quite expensive. They do solve the last mile solution, but they are limited in scale to what we see about perhaps a 10 to 15,000 tonne per annum market. We're looking for scale of 50 to 500,000. So onshore storage applications, they're all compressed. They are high pressure, but they require carbon fiber specialized tanks. So again, it's an expensive process. So if we can unlock that with the simplicity of our of our proprietary design, both from a shipping and onshore and floating perspective. We think we've got a strong opportunity to build a market which is still starting from a low point.
And just in terms of the IP around the design, Martin, can you talk to us about that? Is there any patents over it or any protection there?
Yeah, so we have lodged patents process in the US and Europe. So what we have described is it's a multi-layered nested tank structure. So it's the way that nested structure is put together and then integrated into the hull of a ship and how that stores compressed hydrogen. So that is essentially the simple form of IP. So we've got the patent process in place. That started over a year ago, and we'll be taking that through. So we feel comfortable with where our position is, but I think that's what we can say at this point.
No worries. With the evolving interest in hydrogen, do you have interested parties to produce hydrogen locally to increase supply of hydrogen to export via shipping?
If you're talking about locally in Australia, well, we've got our own TVH2 project, which is proposing export of 100,000 tonnes. We've completed a pre-feasibility level document with the support of the West Australian government for funding for the high energy project. So that's going through its upstream pre-feasibility study. And we have spoken to other developers of larger scale export projects, whether that be in that northern part of Australia. So we are in discussions about alternative projects, but our focus where we see is the low hanging fruit can be smaller volume, shorter distance projects, whether it be in Europe or in sort of Southeast Asia as well.
Great, thanks. And just final question: what do you think are the catalysts for offtake to move from MOU to binding terms?
Well, an offtaker needs to have certainty around timing and cost, and so the large scale projects are still grappling with what's their time frame and what will be their true cost. Interestingly, last week we saw that the NEOM project in Saudi Arabia achieve FID. So it's the first time we've seen a gigawatt scale project achieve that. That's an $8 billion project. So it can be done. We think that compression adds simplicity and flexibility to get to that certainty. And then it's the regulatory process, as we've highlighted in Europe, where those rules and regulations are coming into play over the summer. So I think the customer needs to know, if I'm going to buy and pay for green hydrogen, what are the rules around emissions and calculating that, and then potentially what are the subsidies I am going to receive. So it's about what's the true levelized cost.
Great, thanks, Martin. Thanks all for joining. If you did want to catch up with Martin one-on-one, please contact via the bottom of the email on the announcements, and he'd love to have a chat. Thanks so much for joining, and thanks, Martin, for presenting.
Thanks, Simon.
Cheers. Thanks.